A developer with 6 completed projects and a deal in one of the hottest Sunbelt multifamily markets, he spent 8 months pitching 30 family offices. 2 soft commitments, 0 checks. His placement agent went quiet, and his deal, a ground-up multifamily development that should have closed in 90 days, was still sitting on his desk. This is where most developers stop and blame the market, and that is not what happened here. Here's what I'm going to show you in this video: exactly what killed that raise, the 3 structural mistakes any institutional LP flags before the meeting is over, how we fixed each one here at IRC Partners, and what a comprehensive capital raising advisory engagement actually looks like versus what most developers are settling for in the marketplace. By the end of this video, my goal is to make sure you understand the difference between a simple transactional placement agent that just cares about his commission and a real capital advisory firm, and why that distinction is the single biggest variable in whether you close a $10 million or $100 million institutional round. The difference between a placement agent and a capital advisory firm is not the fee. It's whether they restructure your deal before they introduce you to anyone. And we're going to cover a lot of ground, so stay with me. Advisory firms that offer truly comprehensive capital raising services for real estate developers restructure the capital stack before going to market, align fees to outcomes rather than close dates, and remain embedded across all future capital events through exit. Here at IRC Partners, we're one of the few firms operating in this elite category. When we got on the call with this developer here at IRC Partners, the first thing we did was pull up his LP package. Not his pitch deck, his LP package. Within 30 minutes, we had flagged 3 problems. And here's what matters for you. These are the same 3 problems IRC Partners identifies in the majority of developer materials that come through our process before first engagement. We're talking 6 to 10 calls a day, almost every day. But first, the market context, because this is where most developers misread the room entirely. Institutional capital for real estate developers refers to equity and debt raised from organized capital sources, family offices, private equity funds, and institutional allocators, as opposed to individual high net worth investors. Now, based on Marcus and Milchap's 2025 CRE market report, institutional fundraising hit $121 billion in 2025, up 33% from 2024, marking the first year-over-year increase since 2021. And according to NAIOP's fall 2025 research, North American closed-end funding volumes remain approximately 45% below the 2021 peak. Capital is not disappearing, it is concentrating into fewer sponsors with better structure with institutional grade materials. And here is the number that explains why. Based on our research at IRC Partners Capital Advisory Engagement data from 2025, 85% of institutional LPs rejected a real estate manager over operational concerns alone before the deal ever reached investment committee. Not because the deal was bad, because the package was wrong. Now pay attention to this next part. You might want to write this down. The 3 structural mistakes that kill institutional real estate raises are no catch-up mechanism in the waterfall, a cumulative preferred return set too high, and no stress scenario modeling. Here's what each one actually costs you. Mistake number 1, no defined catch-up mechanism. A real estate waterfall is the distribution structure that determines how profits flow from a development project to the GP and LP investors at exit. A properly structured institutional waterfall has 4 defined tiers: return of capital to LPs, a preferred return to LPs until they hit their hurdle rate, a GP catch-up provision, and a residual profit split between LP and GP. A properly designed catch-up mechanism means the GP receives 100% of distributions until they've caught up to their promote percentage of total profits. So let's look at this. On a $30 million exit, the difference between a waterfall with a properly structured catch-up and one without can exceed $1.2 million in GP earnings before the residual split ever runs. The institutional promote standard for real estate in 2026 is a tiered structure, not a flat 20%. A tiered promote structure that looks like this: 0 promote below an 8% IRR, 10% promote between an 8 to 12%, 20% promote between 12 to 15, 30% promote between 15 and 20, and 40% promote above 20% IRR. This rewards exceptional performance and protects GP economics better than a flat promote on deals that outperform. Institutional LPs in 2026 require GP co-investment of 1 to 10% of total project equity as a non-negotiable condition of engagement. A GP who is not prepared to put capital in alongside LPs will not receive a second meeting with these institutional allocators, and most developers find this out after the fact. So if you're still figuring out your waterfall structure during LP negotiations, you already lost leverage. Okay, mistake number 2, cumulative preferred return compounding at 10%. Now, a cumulative preferred return is a distribution provision that carries forward and compounds when a project misses its hurdle rate in any given period. So in practice, a 10% cumulative preferred return on a 4-year hold with uneven cash flows can add 400 grand to maybe 700,000 to what LPs receive before the GP sees $1 of promote. A non-cumulative preferred return does not carry forward, so unpaid preferred returns from one period simply lapse. And this is significantly better for GP economics, and it's a negotiating point most developers never push on because they do not know that it exists. Our developer had a 10% cumulative preferred. We negotiated to 8% non-cumulative. That single restructure improved projected GP economics by approximately $520,000 on his specific deal before we went back to market. Okay, mistake number 3, no stress scenario modeling. Modeling exit scenarios for a real estate capital raise requires running 3 separate waterfall analyses. A base case as underwritten, a downside scenario with no specific NOI reduction and cap rate assumptions, and an extended hold scenario with compounding preferred return across a 24-month extension. Any institutional LP running proper diligence will run all 3 before they reach investment committee. So if you've not done that work yourself, the LP will run it in their head during the meeting, I promise you. And if your numbers do not survive, they will not tell you why they passed. And if your numbers do not survive, they're not going to tell you why they passed on you. They will just simply pass quietly. Off into the night they go. Every developer shows up with a base case, okay? That's the main point here. The ones who close bring in all 3. So in a downside scenario, institutional LPs model a 10 to 15% NOI reduction from lease-up delays, a 50 basis point cap rate expansion at exit reflecting a softer market, and a 12-month hold extension beyond the projected timeline. And they need to see LP capital fully returned before your promote kicks in under those circumstances. The extended hold scenario goes further, 24 months beyond your projected timeline, with preferred return compounding the entire period. This is the scenario that exposes cumulative preferred return structures for exactly how expensive they are. So we're about halfway through. Now, let me show you why fixing the waterfall alone is not enough, and answer the question this video is built around. When IRC Partners rebuilt this developer's LP package, we ran all 3 stress scenarios with a fully modeled waterfall and showed exactly where LP capital was protected in each one. An institutional grade LP due diligence package for a real estate capital raise contains 6 components. Okay, track record documentation for every completed project, including cost, timeline, and return on capital. You're going to want CPA reviewed or audited financials, a fully modeled waterfall with stress scenarios across all 3 exit timelines, a legal LP agreement with defined LP protections, a market analysis specific to the asset class and geography, and sponsor background documentation with references. And that is what institutional diligence requires. And that is what closed a $28 million round. So if you're evaluating whether an advisory firm offers truly comprehensive capital raising services for real estate developers, 3 non-negotiable criteria separate real capital advisory from a more expensive version of your own Rolodex. Number 1, they restructure your capital stack before you go to market, not after. Any firm that skips this step and goes straight to LP introductions is a referral service, not a capital advisor. Comprehensive Comprehensive advisory means your waterfall, your preferred return structure, and your co-invest requirements are resolved before the first LP conversation happens. Okay, number 2, their fees tied to your outcome, not the close date. A capital advisory firm differs from a placement agent in 3 specific ways. It restructures the deal before going to market, aligns compensation rather than a cash fee at close, and stays embedded throughout all future capital events. A placement agent makes his introduction, collects a fee, and you'll never see him again. On a deal where the GP promote is worth $2 million, only an equity-aligned advisor has a financial incentive to protect that $2 million through exit. A placement agent's incentive ends at close, as I just mentioned. Now, number 3, they stay embedded across all future capital events. A transactional placement agent closes your deal and moves on. That's it. You'll never hear from them again. They'll forget your name in 2 weeks. A comprehensive capital advisory engagement, however, covers every future raise through exit because the LP relationship built on this deal is the foundation for the next one. If any of those 3 are missing, you are not working with a comprehensive capital advisory firm. That's just the sad fact. Now, the targeting problem most developers never solve. The average check size from a family office in real estate ranges from $500,000 to $2 million per deal. Based on IRC Partners' internal database of over 307,000 plus institutional allocator profiles worldwide, compiled across the firm's active engagement history and syndicate partnership with 77 global investment banks, only 13% of family offices write checks of $10 million or more. Those are the only family offices capable of leading your institutional round. The other 87% cannot close your deal regardless of how compelling your pitch is. Now, broad cold outreach to the family office universe means 87% of your conversations cannot close your deal. The comprehensive capital advisory model solves the structure, solves the package, and then takes the package directly to the right 13%. We cover LP package construction and institutional LP targeting in dedicated videos, links below. And we cover LP package construction and institutional LP targeting in dedicated videos on this channel. You'll find the links in the description and on the channel below. But here's what the resolution looked like for this one developer. Once IRC Partners restructured his capital stack, renegotiated the preferred return from 10% cumulative to 8% non-cumulative, rebuilt the waterfall with proper catch-up mechanism and tiered promote structure, stress tested it across all 3 exit scenarios, and rebuilt the LP package to institutional standards, we went back to market. Not to 30 family offices, but to the right family offices, the 13% that actually write institutional checks. Within 6 months, he closed $28 million in institutional LP equity. His promote was protected. The LP relationship was structured for multiple future raises, not just this one deal. The deal did not change. The structure did. And that is the whole game. The most consistent pattern IRC Partners observes across capital advisory engagements is not deal quality, it's sponsors arriving at LP meetings with an unstructured capital stack and no stress-tested scenarios. And that signals to institutional allocators immediately that the GP is not ready. And institutional LPs in 2026, they're not waiting for you to get ready. Based on Knight Frank's Active Capital Survey, 87% of institutional investors by AUM plan to increase direct CRE investment this year, and 62% expect to be net buyers. The capital is moving. The question is whether your structure is ready to receive it before it moves to the next developer who did the work. The developers who close institutional rounds are not luckier or better operators than the ones who do not. They're simply better prepared. So before you pitch another LP, audit your capital stack against these questions. Does your waterfall have a defined catch-up mechanism? Is your preferred return non-cumulative? Have you stress tested your structure across base case, downside, and extended hold with specific numbers in each scenario? Does your LP package contain track record documentation, audited financials, a fully modeled waterfall, and a legal LP agreement with defined protections? And do you have warm access to the 13% of family offices that write checks of $10 million or more? If any of those answers are no, that is the gap between you and a close. Not the market, not the deal, the structure. Here at IRC Partners, we accept a maximum of 7 new strategic partners per quarter by application only. One engagement covers all future rounds, all future capital events, all the way through exit. We structure the capital stack, design the waterfall, build the LP package, coordinate warm introductions through our network of 307,000 plus institutional allocators worldwide and 77 global investment banks and syndicate partners. We only win when you win. So if this resonates with you, feel free to click the link below. It'll be somewhere in the description, and we'll see if you are investor ready for the institutional marketplace to get your project funded.